Are you looking to get a mortgage in 2021 but don't know where to start because of your credit? Well, in today's video, I'm going to teach you the different types of mortgages and what you can do to prepare your credit for a mortgage in 2021. Guys, stay tuned. Welcome back to the channel, guys. If you're new to the channel, I'm Credit Coach Q, and I created the first cloud-based software that allows you guys to put your credit repair experience into your own hands, guys. In today's video, I'm super excited because I have a banger. But before we get into the video, guys, I have one question.
Did you miss me?
I know you missed your boy. I know you missed this here. I know you missed this content, guys. And today, in today's video, I have a good one. Majority of the people that's going into credit repair, especially in 2021, they want to buy their first home, but they don't know where to start. They automatically assume that, I just need a good credit score and I can actually go and get a home loan today. That's not the case, guys. That's further from the case. In today's video, I'm going to teach you the breakdown of what most loan officers are actually expecting from their consumer to actually breeze them through the perfect loan application. So, first thing first, let's dive straight into the meat, guys. You know how I get. The first thing first, I'm gonna go straight into the negative. Probably one of my biggest pet peeves for clients that say they want to get approved for a home loan. They probably make one of the biggest mistakes ever. And that mistake is they're driving their home. What do you mean by that, Gonzalo? Driving your home. They go and purchase a new vehicle or a new used vehicle because they want the stigma of going to their new house with a new car. So they go out and buy new cars before they get the home loan fully finalized. Guys, this is one of the biggest dramatic mistakes that all first-time home buyers make because it ruins your credibility. First of all, if you have a pre-approval, don't buy anything. Don't buy a couch, don't buy a car, don't buy a cat, especially if you have to lease it. Don't buy anything new, guys. What you want to do is you want to have your debt to income ratio as clean as possible. So let's talk about that since we're on it. So it's two basic factors that loan officers are basically looking for when it comes to your approval. And that is your credit and your debt to income ratio, guys. Your debt to income ratio is your expenses minus your income equals what's left over. And what's left over is what they want to see. They want to see a lot left over where they have the confidence to know that you're going to be able to pay this loan back 3-4 times. So that's what a debt to income ratio. When you actually go out and purchase new loans to get new debt, it completely throws off the debt to income ratio and potentially brings your liability down. Bring your liability up on the loan agreement. So I have a small story. I had a client, she had got the pre-approval, everything was looking fine, everything was good. She went out and bought a brand new Mercedes, a brand new E-Class, and she could afford it, had a good job, had good finances and everything. Went to closing day. And the underwriters denied her and told her we have to go back to the drawing board because, quite frankly, she completely messed up the terms and the conditions of that present loan agreement at the closing table because the debt to income ratio went completely south. Guys, what you want to do is make sure that everything is clean, okay? So, first, don't drive your car. Don't drive your home, guys. You never want to put yourself in a position to drive your home. Always remember, it's better to drive to the car lot with your home keys than driving to the closing table with your new car keys, okay? Always remember that, guys. That's a great takeaway, okay? Number two, one of the biggest pet peeves probably for loan officers is credit. I say probably 74% of loan officers can't get the deal done because a client has bad credit. So I'm gonna give you some takeaways. If you have 3 or more derogatory marks on your credit report, don't even start the loan application. I think it's a waste of time. What I would say is get those items removed first. Guys, if you need any help on removing any derogatory marks, guys, go to mycreditapproved.com, guys. We are literally helping thousands of people remove derogatory marks themselves. I love hearing me say that. That is such amazing. We are helping thousands of individuals remove their own derogatory marks themselves. Guys, it's literally the easiest, the most cost-efficient way to actually go into the process and move it without you having to worry about and hoping that a credit repair specialist or a credit repair company is working on your behalf. So guys, that's what you want to do. You want to make sure that your credit profile doesn't have no more than 3 derogatory marks. Now, as far as inquiries, an inquiry is anything that you apply for where you can debt back. So if you go and have Macy's run your credit as an inquiry. Now, if you have more than 5 of those, you possibly can get denied by some lenders because some lenders frown upon any inquiries more than 5. So if you have more than 5 inquiries, it can make your credit file look desperate. It's not mandatory that you have less than 5 inquiries, but I'm just trying to structure your credit report and your file where you don't have any liabilities walking into a loan officer's desk. So that's what you want to make sure. If you have more than 3 inquiries, more than 5 inquiries and more than 3 derogatory marks, guys, go to mycreditapproved.com. If you cannot, or if you do not have the time to do it yourself, our underwriters and our attorneys can actually work on your behalf as well. But guys, we always encourage our clients and our consumers to take this experience into their own hands, guys, because you can actually give this back to your children. Okay, guys, if you find any of this information helpful, please like and share this video and give it out to the public, because this can actually help you structure the home buying process before you even get there. So 2, make sure the credit is good. Now let's talk about the loans a little bit. No, before we get into the loans, I want to talk about a particular piece of debt that can be on your credit profile that you really need to focus on, especially if you are serious about buying your first home. You want to make sure that your student loans are in good standing. You don't want your student loans to be in default because it can hurt your potential in 2 different factors. The first factor is credit. The other factor is debt to income ratio. When you have student loans, whether they're in default or whether they're in good standing, the loan officer is going to apply that to your debt to income ratio. So if you are in default of those student loans, that would be a derogatory mark, and it will offset your debt to income ratio, literally tilting your chances of actually getting approved all the way down, slim chance to none. So you want to make sure that your student loans are in good standings before you actually go into any type of process of the home buying process, because guys, a lot of clients get denied just off student loans alone. So you want to make sure that your student loans are not in default and they are in good standing. They will accumulate your student loans and apply it to your debt to income ratio. I don't know what they'll be, but they will do that. So they will take all of your expenses, all of your bills, and your student loans and apply it and create a debt to income ratio, and you will be able to get approved from there. Now let's talk about the loans a little bit. There's 3 major common loans that loan officers like to use. The first one is called FHA. The second one is called conventional, and the third is called USDA. Now, there is some other loan officers that tend to cater to VA loans, which is the veteran loans, and that is if you are a veteran from the military, you possibly can qualify for those loans as well. Now, the FHA loan, the lowest I ever seen someone get approved for is a 580 middle score. So let me explain what a middle score is. Let me give you an example. If you had a 700, 699, and 698. 698 is going to be your lowest, 699 is going to be your middle, and 700 is going to be your highest. So what they're going to go is, they're going to go off your middle score. So they're not going to choose your highest, they're not going to choose your lowest, they're going to choose the middle score. And your middle score can change literally every month. So you want to make sure you are cautious about what your middle score is. And guys, use FICO. Don't use Credit Karma. Don't use Credit Sesame. Don't use any of those Vantage scoring systems. You want to use FICO because FICO is going to give you the best description of what the lenders are actually looking at. Okay, so FHA, the minimum credit score is 580 middle score. Now, what you want to make sure is you guys don't want to go into the loan officer with a 580 credit score. The lower credit score, the less incentives you're going to get, the higher interest rates you're going to pay, and the higher down payment you're going to pay. So the more credit boost that you can actually apply to your profile, the better chance that you have for actually getting those incentives and those prime interest rates. So don't go to the loan officer with a 580 credit score, guys. You want to go with an FHA loan FICO, at least a 660, at least. If you have a 660, you can get average interest rates, and you will be able to qualify for a decent package for whatever the loan officer can give you, depending on your debt to income ratio. Now, the second loan program I want to talk about is called conventional. Conventional is probably the best when it comes to, in my opinion, because I just like the terms and conditions and also the interest rates that usually apply to the conventional loan. But the process of actually getting approved is a little bit more stringent. It really just depends on your credit score. So the middle credit score minimum that they usually look for is around, I believe, 670, or 680. But like I said, you don't want to go with the middle requirement. What you want to do is at least go middle score conventional at a 720. A 720 is at least what you want to walk to a loan officer table asking for a conventional loan. The third loan that we want to talk about is the USDA loan. Now, I do know the requirement for USDA loan really just depends on the location that you're interested in. I know that they have like a zones depending on the program that they can actually qualify for. So what you want to do is you want to make sure that if you're interested in a property, to make sure that that property is covered within that zone. So if you can find out, that from your realtor, that'd be perfect before you go to the USDA loan program. I think the minimum requirement for that one is around 660. Like I said, you want to go to the table with at least a 700 for the USDA loan and also the conventional. Now, I do believe you can possibly get approved for around 620 with the USDA loan, but it really just depends on your loan officer and your debt to income ratio and your income. So all of those factors actually matter when it comes to the loan approval process. It's just not your credit profile. Guys, if you found any of this information helpful, please leave a like and let us know how you feel. Let us know what loan program that you're interested in the comments below, and let us know exactly the struggles and concerns that you are having with that particular experience. Guys, until next time, take care of yourself and take care of your credit. Credit Coach Q out.